Hello, my name is Drew Toro, and this is my final presentation for accounting for the MBA program at Johnson University. So I decided to do a financial analysis of the company Starbucks. And so first we're going to begin with a brief overview of the company and what it's like. As we all well know, Starbucks, they sell coffee, different pastries, and breakfast foods. Starbucks started in 1971 in Seattle, Washington, by three guys who came up with the idea as they were just avid in academics and also just avid coffee lovers. They essentially just took the idea and ran with it. And it ended up, as we all know, being very successful. So successful that it is actually the largest coffee house chain in the world. And what Starbucks tries to do, what their core values are, is they seek to support the farming communities in very impoverished areas or third world countries by paying above market rates for the coffee beans there. And what that means is, say the farmers are selling their coffee beans at $5 per bag. Well, Starbucks will pay even more than that, say $10 per bag instead of $5, just to help fund the local farmers in those communities and also help them get out of poverty. Over time, since 1971, Starbucks has grown over to 33,000 stores, and you can find them in 76 different countries. So what I'm first going to go over is their financial income statement. This is data that I pulled from their 10K filings, as you can find that online, as it's all public access. So what I first did was take that numbers and data from their 10K filings and put it into Excel, as is a very powerful tool to help do quick analysis, ratios, and numbers. Put myself down here so I can see the numbers. So what we're mainly going to look at is the highlighted things on here. As you can see, the 10K fines went over the 2021, 2020, and the 2019 years. This is good as we can see how the company has changed over the years. What we're first gonna look at is a horizontal analysis, and essentially what this means is that we compare the numbers horizontally, so we can see that change over time. So with the first one here, this is from the year 2020 to 2021. So from those years, there was actually a 23% increase in net revenues. Also keep in mind that these numbers are in millions. So this is $5,543 million. And then from 2019 to 2020, there was actually a decrease in 11%. And what's also actually cool about seeing this is actually now that we have the information from the year 2020, as we all know, that's when COVID hit, the world shut down due to the pandemic. It hurt a lot of stores and businesses. So seeing those numbers, it's actually not surprising. That actually makes a lot of sense. So it's very interesting to see that during the pandemic, their net revenues actually went down 11%. And what we're also going to look at is their total operating expenses. From 2020 to 2021, their total operating expenses increased 10%. But from 2019 to 2020, their operating expenses actually decreased negative 2%. I'm assuming this is because, with COVID, the pandemic, they probably had to shut down a lot of stores and things like that temporarily, or possibly long term, depending on the type of store in the market that it was in. And we're also going to look at is the operating income. Surprisingly, when the world came back on after the pandemic from 2020 to 2021, their operating income increased significantly of 211%. But when that pandemic and COVID did hit, their operating income went down significantly, negative 62%. And the same thing again happened. The earnings before income taxes from 2020 to 2021 increased 360%, and their net earnings attributable to Starbucks increased as well, 352%. And then again, when the COVID hits, it also did a decrease of the earnings before income taxes and also the net earnings attributable to Starbucks, negative 74%. And what also did here on this Excel sheet is a vertical analysis as we compare the different numbers to what the percentage is of the total net revenues, as that's what we compared to, as that's what keeps it at 100%. And so, as we can see here, in 2021, the total operating expenses accounted for 85% of the total revenues. But in 2020, that jumped up to 95%, as I'm assuming they had a lot more, definitely a decrease in net income and revenue due to COVID. So that's why that percentage is probably higher there. And then we can also see this vertical analysis in the earnings before income taxes, as in 2021, that accounted for 18% of the total net revenues. But it's interesting to see in 2020, it was actually a lot lower at 5%. And then the same thing for the net earnings attributable to Starbucks. In 2021, it was 14%. In 2020, it was at a whopping 4%. And then in 2019, it was back up to 14%. So it's interesting to see this 3-year period, as in 2019, things were normal pre-COVID. And then in 2020, when COVID hit, it definitely caused a lot of a decline for the business. But then it seems like the company was able to easily jump back up after the pandemic and things opened up to even go back to normal, or even be better than it was, as we can see that later on. So here are some more ratios and numbers that we can kind of go into more detail from that net income statement. So in 2021, their gross profit was at $4,487 million. And then in 2020, their gross profit was significantly lower, $1,239 million. And then in 2019, we can see that it was at $3,780 million. So again, as we can see from 2019 to 2021, they actually came out better after the pandemic and things like that. And then their gross profit rate, again, increased. In 2021, it was at 15%. And then in 2020, it was at 5%. And then in 2019, it was at 14%. So again, their gross profit ended up coming out better than they were pre-COVID than after COVID. And then so what that change is from the previous years, so from 2020 to 2021, their gross profits, their net income increased 352%. That is very significant. But when COVID hit, that net income dropped significantly to negative 74.2%. And then what their net income exactly was in 2021 was $4,199 million. But then when COVID hit in 2020, it was at $928 million. And then their operating income, again, it actually ended up being significant. significantly higher post-COVID than it was pre-COVID, as in 2021. It was at 4,872 million. But in 2019, it was at 4,078 million. And then in that change of the operating income from that previous year, from 2020 to 2021, it increased 212%. But then when COVID hit, it caused a decline in negative 61.7%. Next, we're going to look at their balance sheets and do some more financial analysis into that. So here is their balance sheets. Now for this one, it doesn't include a 3-year period. It just includes the years 2021 to 2020. And so what I again did is a horizontal and a vertical analysis. So in this horizontal analysis, we'll look at some of the highlighted numbers on here. So for their total current assets, there was an increase, 25% from 2021 to 2020. And then what was interesting is that their long-term investments actually increased very significantly post-COVID. Post-COVID, their long-term investments increased to 1,266%. I'm assuming that's just because, when the COVID pandemic hit, they probably had to put a pause on all long-term investments. But then since the world has opened back up, they've probably gone back to normal and gone back to now doing some more long-term investments. And then we also see here their total assets in 2021 ended at $31,392 million, which is, again, a 6.9 increase from the previous year in 2020. And then their total current liabilities actually increased from 2020 to 2021. It increased 11%. And then their total liabilities actually decreased negative 1.3% from the previous year. And then what I also did here is a vertical analysis. So for this section, it compared it to the total assets. So in 2021, their current assets accounted for 31% of their total assets, which is an increase from the year 2020, as it was at 27%. And then again, we can see here their long-term investments increased from 2020 to 2021, as their total assets in 2021 accounted for 9% of their total assets. And then for the liabilities and equities, we compare it to the total liabilities in shareholders' equity, as that kept at the comparable number at 100%. So their total current liabilities accounted for 26% of the liabilities and equity. And then their long-term debt accounted for 43%. We can see here in 2020, their long-term debt was actually at 50%. But then in 2021, they were able to decrease that down to 43%. I'm assuming here because now, again, post-COVID, they were probably able to generate more revenue and income and not have so much long-term debts or liabilities for the company to pay for in long term. So now we're going to go over some ratios of the company. And we're also going to compare it to one of their biggest competitors, Dunkin' Donuts, and also compare it to the industry as a whole. And also want to keep in mind here, so on the right side here, I have those comparable numbers of Dunkin' Donuts to the industry. Now, I wasn't able to find all of the data to do that, to compare that. So what I did here was I tried to find my best numbers on the internet and try to put the most of that can on there. So first, we're going to go over the cash ratio. Their cash ratio was at a 0.79%. And to calculate that, we take their cash and divide it by their current liabilities. And essentially what this means is it just shows the company's ability to cover the short-term liabilities with only using cash on hand. So if that number is less than 1, then essentially it just means that the company does not have enough cash to pay off their current liabilities. And for Starbucks, as we can see here, at being at 0.79%, it's just barely under that one margin to not have enough cash to pay off current liabilities. But that's not too much of a big deal. But if we were to compare that to Dunkin' Donuts, Dunkin' Donuts actually has a higher than 1 ratio for their cash ratio at a 1.06%. And essentially that just means that if Dunkin' Donuts were to just take all the cash they have on hand, they would be able to successfully and even a little bit more pay off their short-term liabilities. And the next ratio here is their quick ratio. That's calculated by taking all their quick assets and dividing it by their current liabilities. And essentially what this ratio shows us is it shows these companies' ability to meet their short-term obligations with just their most liquid assets, but it's not including their inventories. And so with Starbucks, their ratio was at a 1.0. And if that number equals to 1, then that just means that they have just enough assets on hand to liquidate to pay off their current liabilities, to say if they were to file for bankruptcy for any reason. So this shows us that Starbucks does have enough liquid assets on hand to pay off any of their current liabilities. And comparing that to the industry average, that's at about 1.42%. And next here, we have a current ratio. The current ratio is calculated by taking their current assets and dividing it by their current liabilities. And this basically measures the company's ability to pay off their current liabilities with their current assets. So with Starbucks, they have a 1.2% or 1.2 current ratio. And so if that number is greater than 1, then it means that they're able to meet all their short-term liabilities if they all were to become due at once. And so to comparing this with the industry average and their competitors, their industry average is at a 1.63%, and Dunkin' Donuts is at a 1.62%. So while Starbucks is just under the industry and their competitor, that's not too much of a big deal as their number is above 1, which means that they're able to meet all their short-term liabilities if they become due at once. And we're next going to look at the asset ratios. First is the asset turnover. This is calculated by taking Starbucks's total sales and dividing it by the average assets. And this essentially shows the company's efficiency and how a company can use its assets to generate revenue. So with a higher ratio, it means that the company is more efficient. But then if there's a lower ratio, then the company is less efficient. So with Starbucks, they're at a 0.03 asset turnover ratio. So that will probably mean they're on the lower ratio and the less efficient side. But with the industry average, it is at a 0.56 ratio, and Dunkin' Donuts is at a 0.34. So with Starbucks, they are below the industry and their competitors. Next here, we have the inventory turnover, and that's calculated by taking the cost of goods sold and dividing it by the average inventory. And this basically shows how effectively inventory is managed and the number of times that the inventory is sold within a period. So for Starbucks, they're able to basically sell their inventory 8.63 times within a period. And with the data that I found online, it shows that the industry average is actually a lot higher at a 97.55. And then when I was trying to calculate this for Dunkin' Donuts, I wasn't able to, as on their balance sheet, they didn't have an inventory listed on it, so I wasn't able to calculate that. Next here, we have the accounts receivable turnover, and this is calculated by taking the sales and dividing it by the average accounts receivable. This basically shows how effectively it collects its debt owed toward credit that the company extended. So the lower that this number is, it means the more efficient they're able to collect on its debt that it does owe towards the credit that it extended. So for Starbucks, their accounts receivable turnover is at a 31.88 ratio. The industry average is at 33.96. So Starbucks is just below the industry average, but they are doing a lot higher than their competitor of Dunkin' Donuts, which is at a 15.42. Next, we're going to look at leverage ratios. First up here, we have the debt to equity ratio, and this is calculated by taking the total debts and dividing it by the total equity. So the higher that this number is, it basically means that the business is not able to provide sufficient equity to fund itself. And then luckily with Starbucks, it's at a low ratio number of negative 6.91. So that means that Starbucks is able to sufficiently fund itself. Next ratio up here, we have the total debt ratio. This is calculated by taking the total liabilities and dividing it by the total assets. And this shows the amount of risk that the company has required. If that number is higher than 1, then this means that the company's debt is funded by its assets. And what a really high ratio can show is that it indicates that it can be in pretty big trouble with its creditors. And luckily for Starbucks here, it's only at about a 1.17 ratio number. So it's not very too high above that, but I would say that's a good number to stay at. And the next ratio here is the long-term debt ratio. This is calculated by taking the company's long-term debt and then dividing it by what equals the long-term debt plus the total equity. And what this does is it measures the percentage of assets needed to liquidate to pay off the long-term debt. So of a ratio of a 0.5 is typically considered good, but if that number tends to be higher, then what a higher ratio can indicate is that it will need to sell more of its assets to eliminate its debt in the case of a bankruptcy. So for Starbucks, they are at a 1.64 ratio. So in the event of a bankruptcy, they would probably have to sell more of its assets to eliminate that debt. But hopefully for Starbucks that I'm assuming that they will have to file for bankruptcy anytime soon as they handle all their money properly. The next ratio here is the profitability ratios. We have the return on assets, and this is calculated by taking the net income and dividing it by the average total assets. And this basically shows that how well the company uses its assets to generate profits. So with Starbucks, they're at a 0.96 ratio, which is actually above the industry average, which is at a 0.31. And it's even significantly higher than their competitor of Dunkin' Donuts, which is at a 0.05 return on assets ratio. The next ratio on here is the return on equity ratio. This is calculated by taking the net income and dividing it by the average stockholder equity. And what this shows us is how well the company uses its investments to generate profits. So for Starbucks it is actually at a negative 4.43 ratio. And then if we compare that to the industry average, it's actually at a 17.02. So Starbucks is on the lower end on that compared to the industry. The next ratio on here is the profit margin. This is calculated by taking the company's net income and dividing it by sales. And this basically shows how much profit are from the company's sales. And so what a company does, if they want to strive for a higher ratio profit margin, then what they can either do is either cut costs or try to increase revenue to get that profit margin up. And if we compare Starbucks's profit margin, which is at a 14.7%, compare that to the industry average, is that it's kind of a little bit lower as the industry's at 26.11%. And then it's again lower compared to its competitor of Dunkin' Donuts, as it's at a 20.33%. The next ratios on here is the market value ratios. The first on the list is the price to earning ratio. This is calculated by taking the price per share and dividing it by the earnings per share. And this essentially relates to a company's shares price to its earnings per share. So when a company, if it has a high price to earning ratio, then this means that the company's stocks is either overvalued or investors are actually expecting high growth rates in the future. And then if we could, and looking at the S&P 500, typically their price to earning ratio can either range from about 5 to even 120. And so Starbucks is at a price to earning ratio of 24.2. And then the industry is actually at a whopping 111. And then again, Starbucks is actually lower with the price earning ratio, as Dunkin' Donuts is at a 40.2. The next ratio on here is the market to book ratio. This is calculated by taking the market value per share and dividing it by the book value per share. This basically compares the company's current market value in that current time, however the market is being at that time, compared to its book value, which would be what the number is and the company is based in its books. So a low ratio is considered less than 1. And this basically equals or means that the stocks are either undervalued, while a higher one above 1 would mean that the company stocks are overvalued. And for Starbucks, it is actually it's just under 1% or 1 ratio, as it is at a negative 0.1. But the industry is at a 13.91. And then Dunkin' Donuts is even lower than the industry and Starbucks, as it is at a negative 6.47. Basically, looking at these numbers, we can see that Dunkin' Donuts actually, their stocks must be pretty undervalued compared to Starbucks. And so, in conclusion, I would recommend Starbucks as being a worthy investment for the long term. This is for multiple reasons. First, just by simply looking at the financial statements, their net income, the balance sheets, as we can see just how the company did pre-COVID, during COVID, and then post-COVID. So what the company did post-COVID actually ended up being a lot better than it was pre-COVID. And this is for many reasons. As the company expanded more on their mobile ordering systems, as they had to definitely increase on their drive-throughs and then their curbside orderings, because with COVID, a lot of indoor dinings had to close So what Starbucks did to account for that, to kind of basically stay in the business, is to they basically focus a lot more on getting their drive-through systems work more efficiently, and then do a lot more mobile ordering. And they also revamped their rewards plan to make it more appealing to people and to kind of keep that business keep coming back to them with people getting rewards and wanting to use it. Um, and then over the years, or because of those expansions of the mobile ordering and the rewards plan, sales actually went up 8%. And also during the pandemic, the average ticket price actually increased, as it seemed that people were going to Starbucks less but buying more when they did. That's essentially what that means of the ticket price increase. But as things went back to normal, the average ticket prices actually started to decrease. However, the number of orders increased, and this is mainly because people started going back to work, um, and kept going their daily Starbucks runs. And over the past 5 years, their sales have increased 4.1%, and I expect them to even keep going over the years. And over the past few years, from 2020, they opened 1,400 new stores. In 2021, they projected to open 2,100 stores. And then over the next 10 years, their projection is actually open 55,000 more stores. So that's basically the reason why that I think that Starbucks would be a worthy investment, as it looks like they have a bright future. Thank you. Here are my references.